So, since recording these in PowerPoint is obviously not an option because they become so big that we cannot load them up to Canvas, I'm going to actually be recording them for YouTube and sharing links. However, what I will do is that there will be multiples for each one of these topics rather than one exceptionally large lecture. So, we're going to start with performance evaluation using variances as standard costs. This is chapter 22. I'm just going to lecture on this information. On this, we will actually have homework for this particular chapter, and I will post that to Canvas. So, standards. These are your basic performance goals. Manufacturing companies often use standard costs for a variety of different parts of the elements of manufacturing. That's our direct materials, our direct labor, and our factory overhead. We discussed, and I used the word standards a little bit when I was talking about budgeting. Now we're going to kind of build on that for you. Accounting systems that utilize standards for their product costs are what we call standard cost systems. They allow management to determine how much a product should cost, standardize it. What should it be? And then we go and afterwards we look at how much it actually did cost. When we compare those actual costs with the standards costs, we look at what the exceptions or the variances are and how they are comprised. This type of reporting, by principle of exception, allows management to focus on correcting those cost variances in the areas in which they occur. Setting those standards, though, requires some joint efforts. We have our accountants that are involved, there will be engineers, a variety of management personnel. The accountant is going to take the information, it's going to convert the results of all of the judgments and the process studies and equate that to a dollars and cents. It's going to give us a measurement. The engineers, cooperating with their operations managers, are going to look and identify what materials, what labors, what machine requirements are going to be needed to produce the product. They're looking at it from an operational perspective. They're going to provide all the data to the accountants who are then going to create that dollar and cents measurement. Amongst the standards, we have some types. First one is the ideal standard. These are theoretical. They can be achieved in the most absolute perfect operating conditions. This is the land of sunshine and unicorns. Nothing goes wrong. There's no ideal idle time. There are no machine breakdowns, no material spoilage, no materials breakage, no employees aren't sick. Everybody's working at the highest level of efficiency and effectiveness. So, as you can imagine, this absolute ideal standard is often not something that is actually encountered. To provide only ideal standards actually creates kind of a negative environment and would have a negative impact most of the time on the performance of employees or managers. And that's because when they look at them, they're going to say, there is no way I can do this. They are asking more than I am capable. They're asking more than we have capacity to do. Stop and think when you are presented with some type of an objective or a goal that is so high and so far outreaching, you know there is no way that you could do that realistically. Now, you might be able to do it theoretically. For example, somebody might be able to pass all four parts of the CPA exam in the first shot if they had it in the first shot in the first 6 months of the exam windows. Absolutely possible. Can happen. They could take all four parts within 6 months and pass all of them. However, realistically, you have to factor in life. You have to factor in illness. You have to factor in jobs. You have to factor in study time. You have to factor in a lot of things. So, yes, somebody might be able to do that. Chances are they aren't going to be able to do that. The second type of standards is what we call the currently attainable standards or normal standards. With a reasonable amount of effort, these are absolutely attainable. They can be done. These are the types of standards which most companies use and allow for the normal things that are going to happen in production: difficulties, mistakes, waste, machine breakdowns, employees getting sick, all those things that happen in real life. These are more real life standards. When these are reasonable standards are used, then employees can focus on the costs. They have something that is attainable, and they are likely to buy in and put forth their absolute best efforts at effectiveness and efficiency and be more aware because they feel that this is something that they can do, something that they can impact. Now, what works for today doesn't necessarily work for tomorrow. What worked for yesterday might not work for today. So when we think about that, we've got to review and we've got to revise standards because business evolves, processes evolve. I want you to think about that for just a split second here. Let's jump back, 5, 10 years, and let's think about what business was like then. Is it the same as businesses today? Are the processes the same? Are the materials necessarily the same? No, it's not. And because business continues to evolve, so must our standards. So, periodically, what management will do is they will stop and they will look at their standards. They want to be sure that what they're using reflect the most current operating conditions. Because remember, we compare standards to actual. If you're using something that's far out of date, then you're going to have a large variance and your budgets are going to have little validity. Now, you don't automatically revise your standards just because you experience different actual costs, but you do want to revise your standards if prices, product designs, labor rates, manufacturing methods, any of these types of things undergo some type of change. Now, there are a lot of critics for the standard costs. They say using them limits operating improvements by discouraging your employees and your operations to stay within the standard. They don't encourage you to think outside the box. A lot of times they're very difficult to maintain in a dynamic manufacturing environment. Your standards go stale. Sometimes your employees may lose sight of the larger objectives of the organization by only focusing on efficiency improvements, by only looking at one specific tree. They don't necessarily see the forest. So this can limit what their focus is and what they're aiming to achieve. And by focusing only on their one little element, they could actually cause harm to other operations that rely on them. An organization, a business, manufacturing is much like a body. All of the different parts have to work in conjunction. If one part is only working ideally for it, then it may not be contributing what's needed for another part. And in the dynamic environment, things are changing. So that one area is not changing accordingly. It is not supporting what it needs to do. However, being aware of some of the limitations and the areas where we may have issues when using standard costs, we can actually use those weaknesses and turn those into strengths. Whenever you are confronted with something like that in a work environment, I want you to stop and think, is there a way to use what we do use, yet have it function outside of its normal parameters. We talked about budgets in the last chapter. So when we are entering into budget evaluation and we're looking at the difference between actual and budget, that's budgetary performance evaluations. And many times we do this budget, we create the budget using these standard costs. This gives us a dollars and cents measure that allows us to equate what we expect to happen. We're going to take Western Writer Incorporated. They're a manufacturer for blue jeans, and they use standard costs in their budgets. The standards for direct materials, direct labor, and factory overhead are separated into two components. We have our standard prices and we have our standard quantities. The standard cost per unit for direct materials can be broken down by taking standard price and standard quantity. We can do this for direct labor, direct materials, and factory overhead. This specific slide is actually going to show how that breaks down. So we have $5 per square yard of direct materials. This is what our engineers and our operation managers have determined is necessary in order to generate 1 unit. The quantity per pair of 1.5 square yards. So when we are creating a pair of XL jeans, we have $7.50 in direct materials invested in it. We have a standard price of $9 per direct labor hour. This is our basic average for direct labor. We know it should take 0.80 hours to create a pair. So for direct labor, we have $7.27 standard costs per pair of XL jeans. The factory overhead is a variety of components, as you are aware. We break that down to recognize that based off hours, that should be $6 per hour. If it's 0.80 hours, our activity base, to generate 1 pair of XL jeans, then we have $4.80 in factory overhead invested, giving us a total cost standard per pair of XL jeans of $19.50. So when we are preparing those budgets, that production budget, costs of goods budgets, all of this information are the things that we're using to do that. Now, we talked about the master budget just a little bit and how all those various budgets, the sales budget, the production budget, the sales administrative expenses budget, the cost of goods sold budget, all of those roll up and create our master budget. We create it based on what we expect, what we plan for sales and production. Those budgeted costs for materials purchases, for direct labor, and factory overhead are typically determined by multiplying their standard cost per unit by that planned level of production as associated in the production budget. The budgeted or standard costs, we then take and we compare those to the actuals during the year for control purposes. Are we as efficient as we expect to be? Are we as effective? Are we not? What is causing the drivers to be different? Are we selling more? Are we producing more? Or is it a higher cost? Instead, is our standard cost $9 for direct labor hour, but we're really experiencing more of a $10? These are all the things that we can control then. We can go in and evaluate. If we're not constantly evaluating in a company, then we might have issues and we might end our year in a much poorer position. Or maybe we do phenomenal, but we don't know why. These types of evaluations allow us to begin to define our whys. And when we can identify those, we can either compensate or see if we can replicate. Those differences, when we're going back and looking between the actual and the standard costs, are what we call cost variances. A favorable is when the actual cost, when what actually happened is less than the standard cost at actual volumes. An unfavorable cost variance happens when that actual cost actually exceeds the standard cost. This slide is just a little graphic to kind of remind you of how that breaks down versus what is favorable and what is unfavorable. Continuing to talk about budget performance and reporting and evaluations. The budget performance report is a report that summarizes those actual costs, the standard costs, and the difference for the units that we produced. This is based on our actual production, what really happened, rather than planned production. We'll take a quick look at one of those here real quick. So Western Rider produced these jeans during the month of June. They actually produced and sold 5,000 pairs. The actual costs that they incurred are broken down here with 40,150 in direct labor, 38,500 in direct sorry, that was 40,150 in direct materials, 38,500 in direct labor, and 22,400 in factory overhead for total costs of $101,050. This is the information that we can compile from the current accounting reports because this is what actually happened. Now we're going to take that and we're going to overlay it beside a standard calculation. So based off our standards of 5,000 pairs, because we want to look at it on an apples to apples basis, 5,000 pairs are what we actually experience. So let's look at what happens when we have standard costs at our actual volume. So 5,000 pairs of jeans at $7.50 of direct materials standard costs should be $37,500. Those same quantity of jeans and direct labor at $7.20 per pair, remember that's 0.80 of an hour, should be $36,000. And then for the factory overhead at $4.80 per pair should be $24,000. When we come across to the next line, we take our actual, we reduce it by our standard. Now here you'll notice that we have dollars that are positive, and I say that with the air quotes, and negative with the air quotes. In this particular case, we see that anything that is within parentheses or negative is considered favorable, whereas a positive number is unfavorable. We can identify that both direct materials and direct labor had cost overruns and resulted in unfavorable performance between our actual and our standard costs. However, our factory overhead is favorable. We experienced less of it than we had initially anticipated. However, on a global setting, we are unfavorable by $3,550. The total manufacturing cost variance, the difference between the total standard costs and the total actual costs for the units that were actually produced, is used for control purposes. Each of those variances is then separated into the two additional variances, the components that make it up. We have our direct materials variance separated into price and quantity variances. This is because standard and actual direct materials costs are computed by taking actual price times actual quantity to determine our actual direct materials, and then standard price by standard quantity for standard direct materials. So we take the price difference between actual and standard. What did we actually experience there? And then the quantity differences. to determine the direct materials cost variance. So with this, the actual and standard material costs may differ because of a price difference, a quantity difference, or potentially both. We want to know where it happened. This can be done for direct labor as well. As you can see, it is the exact same type of calculation. Our total overhead variance is separated into what we call our controllable variance and a volume variance. That's because factory overhead has both fixed and variable cost elements, and it uses different variances than the direct materials and the direct labor, which are solely variable costs. Here's a quick snapshot for you on the manufacturing cost variances. We're at slide 23. I will cut this into 3 different lectures. So we're going to go for about another 5 slides before we come to an end of this first lecture. Now, we talked that total direct materials and direct labor are separated between costs and cost variances for analysis and control purposes. We have to analyze all of our data in order to be able to control it. Otherwise, we are trying to control something completely blindly, and we won't necessarily be effective, and we certainly won't be efficient in doing such. So here's just a quick snapshot on the direct materials and direct labor cost variances, what they're made out of. Then we have the materials price and the materials quantity, the labor rate, and the labor time. When we go into this analysis, this is what we'll do. We start with my friends at Western Writer. We're going to be working with jeans in this particular chapter. Now, they reported an unfavorable total direct materials cost variance of $2,615 based on the production of 5,000 XL style jeans. We know the actual costs were $4,150, and based off standard costs, it should have been $37,500. The actual costs incurred consist of this breakdown. We had a price of $550 per square yard multiplied by 7,300 square yards. Now, what we were expecting is $5 per square yard and 7,500 square yards. You'll notice that in the actual, we used less material. Therefore, we were more efficient. However, our per square yard price was higher than we had initially intended it to be. Calculating the direct materials price variance is computed by taking the actual price minus the standard price and multiplying that by the actual quantity. We will go ahead and do this for Western Writer here in the next slide. If the actual price per unit exceeds the standard price per unit, the variance is deemed unfavorable. This positive number or unfavorable variance can be thought of an increase in cost, a debit, a cost overrun. If the actual price per unit is actually less than the standard price per unit, the variance is deemed to be favorable. This negative amount or favorable variance can be thought of a cost savings, a decrease in costs. A decrease in costs is a credit on your income statement. Now, taking Western Writer Incorporated, we have an actual price of $5.50 minus the standard price of $5. So we are 50 cents, and we multiply that by the 7,300 yards. That is actually the amount that we used. So that gives us our $3,650 unfavorable variance. Moving forward into direct materials, the direct materials quantity variance is taken by taking the actual quantity minus the standard quantity, then multiplying that by what the standard price should have been. If the actual quantity for units produced exceeds the standard quantity, the variance is considered unfavorable. This positive amount or unfavorable variance can be thought of increasing of our cost overruns. If the actual quantity for the units produced is less than the standard quantity, the variance is considered favorable. This negative amount can be thought of as decreasing costs. Taking a quick look at my friends at Western Rider. For June, they had 7,300 yards of actual yardage. We expected that there should have been 7,500 yards for this quantity. And at the standard price of $5, then we would have a $1,000 favorable variance. Here's a quick little graphic for you looking at the direct materials variance relationships and how those break down in a graphic form versus just talking about it and showing you those calculations. So there was a $3,650 direct materials variance. This is the result of that 50 cents per unit cost overrun that we experienced. However, our staff is phenomenal, and they were able to produce at far less than we were initially expecting as far as consumption of actual materials. This consumption of actual materials difference of $1,000 offsets a portion of that direct materials price variance. So although we paid more per yard, we used less yards. And those two combined give us only a $2,650 total overall variance. Now, as these variances are discovered and where they're discovered, is it in our direct materials price? Is it in our quantity? What are the drivers? We need to report that to management. And in doing so, we want to report to the management manager that's responsible for the variances. So if there is an unfavorable quantity variance, it could be because the equipment wasn't properly maintained, was breaking down, large waste, whatever the particular cause is. Could be from low quality direct materials. You want to chase down what those unfavorable variance drivers are and see what you can do to rectify them. The person who would be responsible for rectifying that would be the manager. Now I'm going to go ahead and move to the next slide. And on this slide, we have an example exercise. This is the direct materials variance. I want you to go ahead and calculate this direct materials variance, and then you will start the next lecture, which will come in with the answers.